Hey guys, how you doing today? Hopefully the video finds you doing well. Want to talk to you today about the marketplace as it pertains to those of you that are looking to purchase, refinance, invest in residential real estate in the upcoming year. A lot of economic data that's coming out, and with the advent of the internet and all of us and our opinions, it could be very confusing for those of you that are just wanting to just want to buy a house and get it in the best case scenario for you and your family, right? You want the best bang for your buck, like we all do. That's the reason we're coming on now. I see a need for someone like myself to be able to explain things the way I explain them, and it seems to resonate with a lot of people. So, without further ado, the theme of today's market update is leading indicator. I want you guys to understand that we need to learn how to go where the puck is going. I think Wayne Gretzky, for those that of you that know who he is for hockey fame and glory and lore, he says that he always used to skate where the puck was going, opposed to where it is currently or where it has been. Okay, so leading indicator. That's what I want you to think about as we go through the numbers today. All right. So first thing we want to look at Market Watch. You guys can pull this up on your computer. Try to go to resources that you guys can get to that are free. But pretty heavy week this week, in my opinion, because we're looking at leading indicator type data, and not all this data is leading indicating. So things like the S&P Final U.S. Manufacturing Index, things like the job openings, ISM manufacturing. Anytime the Fed speaks, anytime we get an insight as to how they're thinking, because they control and manipulate so many things, right? That's always good. Auto sales, good canary in the coal mine, if you will. Again, ADP, I'm going to reference ADP is one of their economists, Mrs. Neela Richardson. That's who you see on the thumbnail. But she made some very key points. Um, but I like ADP because they're on the ground, boots on the ground, right? Real companies that go to them and use them for payroll, HR services, things of that nature, right? I like them. Um, and then, we can't discount the U.S. employment wage reports because the U.S. the government employs a lot of people, right? But saying that, a lot of these data points, in my opinion, are lagging. Okay, they lag. All right. And case in point, like today, earlier today, for those of you that have been watching, again, we're teaching you guys how to watch the 10-year Treasury note. Okay. And if you want to go deeper, you want to watch the relationship between the 2-year and the 10-year. If you really want to get a gauge as to how mortgage rates work. And all this week, right, we've been saying anytime that this is trading, it's yielding beneath 4%, that's a good thing. Earlier today, as a result of the U.S. employment report, right, the employment rate and the U.S. hourly rate, that 10-year note went over 4%. As a result, we can see that interest rates are up. If you've been following over the last week, you kind of see interest rates have been down. Not a big tick up, but saying all that to say you guys can get an idea and understanding of how these things work and what you need to look at, right? So as you can see, just across the board, rates are somewhat up today. Not a big move, but they're up, right? So back to what I was saying about trailing and leading indicators. This U.S. economic report is a trailing indicator, in my opinion, because of how they track data. Um, they might give you a call on the telephone and say, "Hey, are you working?" I don't know how confident I am with that type of information. Moreover, even with ADP, moreover, when you go back and look next month, we'll probably get a revision, and it's always a revision to the worst. So yeah, they're all kind of grasping for straws, and I understand it's a lot of data that you're trying to get an idea with, but keep that in mind if you're on the sideline looking to buy a home and you're fixated on interest rate, because you're going to miss an opportunity. Stay with me, okay? And as we go, if anybody has any questions, comments, or concerns, or likes to give your opinion on where the market is going, because at this point, it's don't let these suits fool you. They don't know either, right? We're all learning how to look at the information, kind of look at history a little bit, but the Fed seems to be driving this bus, right? So anywho, out of the stuff that we got today, the report that I'm really excited about is the ISM Services, right? Because again, these are businesses. These are folks on the ground that are doing business. And if they see a slowdown coming, who's better able to let us know that, hey, things are slowing down? Might not be broken, right? It might not be catastrophic, but the employment reports, when you're just calling folks on the phone and asking if they're working, right? And they're lagging, just like inflation when it was really taking off, and the Fed was somewhat slow in responding because they were telling everybody that it was transitory, only to overstep, in my opinion, and increase the Fed funds rate rapidly over a short period of time, right? Because they're trying to bring that inflation down. Again, leading, trailing indicators. So ISM Services, leading indicator. Uh, ADP, I'm going to pull her up. This is chief economist, right, at ADP, Mrs. Neela Richardson. This is the gist of the report yesterday, and this is a leading indicator. Let's read here. It says, we are returning to a labor market that's very much aligned with pre-pandemic hiring. Good thing, right? Coming back to some normalcy, right? And the numbers show that, okay? It says, while wages didn't drive the recent bout of inflation, okay? That's key. And here's the leading part of this statement, the leading indication part and indicator part. It says, now that pay growth has retreated, pay growth has retreated. So if you're watching the numbers today, you'll look and say, well, man, they were expecting 170, got 200, and what is that, 16,000? They're saying the U.S. unemployment rate's 3.7%. Great, right? And they're saying the hourly wages increased from what they were expecting. But again, this is a lagging indicator, okay? This is December, lagging indicator, and really probably October going into November. Lagging data, all right? Where you have ADP, they are in the business of doing payroll and things of that nature for businesses. ADP, Paychecks, a lot of these places, you got to look at what they're saying, because they're in the midst, right? You've been to one of your kids' basketball games, right? Maybe you was that guy, that girl back in the day on the floor, and from the stands, you're like, shoot it, do this, move your feet, move your feet. But it's different when you're on the floor, when you're in the field, right? Especially if you're not in shape. So say that to say this: ADP's in the field, they're in the mix, and so the key thing is that there is a decrease, right? There's a retreat in the increase of wages. Why that's important is less money in the economy, less money to chase goods, right? You got a lot of dollars chasing homes in this context, and I'll show you that here in a minute. You know what? Yeah, I'll show you here in a minute. Then the prices are going to inflate. Now, this is a key thing, guys. This is a key thing. Let me jump back over here. This is a key thing that I want you to understand. Do not misconstrue a decrease in inflation with, or a decrease in the rate of inflation with price depreciation or price deflation. That's something you really don't want. And I know a lot of you guys want prices to go back, but if you think about it, we're going to be all in a bad way, right? Unemployment is not going to be at 3.7%. It's going to be much, much, much higher. So I get it. I get folks want prices to go lower, but if you look, however long you've been living, if you're an adult, prices go up, right? And they normalize. You have to come up to that level. Very rarely, and especially in some big ticket items such as a home, you don't want to see the depreciation, the devaluation of the home or a majority of homes over a period of time, because that means the whole system is in a bad way. So the rate of inflation is what's coming down. But as you'll see here in a minute, and I'll use Texas as the micro, and then you can blow it up macro or apply it to wherever you are. That's why these home prices, they've adjusted some, but a home is not going to adjust in price, say like uh, a beverage, a soda pop, an adult beverage, or something of that nature. Completely different metrics. So you have to understand that as you're learning how to watch and determine when you're going to enter the market. Hopefully that makes sense. Okay. So back to Mrs. Richardson, chief economist at ADP, right? In the field. So the good news is, while wages didn't drive the recent bout of inflation, now that pay growth has retreated, any risk of a wage price spiral has all but disappeared. Again, because if wages are really going up, like this lagging indicator is telling us, then that might be an issue, right? Because the Fed may have to come back in and raise rates because they're still trying to fight inflation. But if you look at the numbers and the data, the trend is inflation is coming down. Okay. So the reason I feel comfortable with that is because when you look at this ISM Services report, anything once you get to 50 or below, that's not good. Now they've since revised this from when I came on live or was getting ready to come on live, but when it first came out, the number was like 43%. But this index, anytime it's low, and it's in the 50s right now, this lets you know that what the chief economist is saying is accurate because it's a leading indicator. Hey, folks aren't buying as much. We didn't hire as many people during the holiday season, things of that nature. Businesses are becoming more lean and efficient because they're not just able to pass those costs on to you. There is a point of diminishing returns with everything, right? And so now, if they want to make money, folks have to produce. They're looking at you. So if you've been, if you not only is AI on your behind, if you've been leeching and stealing, right? But now folks are even looking even more. They're trimming the fat, okay? Because we have to make our money by selling more volume as well as being more efficient. That's what this is saying, and that's what this report is saying, in my opinion. So, not too worried about the lagging indicators. I'm more concerned about the leading indicators. Okay, leading. So now I think I made my point there. I think we looked at the rates here. Let's jump back over here. Pardon me. So I'm leading indicator, IMS services. Now going forward, what's real important, and you guys can read these notes too, right? From the Richmond Fed president. He's basically gonna, I'm repeating what he's saying, right? The Fed sees that the thing is working, things are working, and they don't necessarily, they see rate cuts coming. We just don't know when in this year coming, right? So this is a great point. Let me jump back. If you're on the sideline and you're not sure of where you are, what you can't do is react. You have to be proactive, right? So right here, you see that? Either click this, take your phone out, take a picture, okay? The first link is how you schedule a consultation, or down in the description. Schedule a consultation. Let's have a conversation first to see if we're a fit. And if so, you got to get properly approved and ready to go. We can help you put the team together as far as a realtor is concerned if you don't have one. Or if you have one, we need to have a meeting of the minds to know which way we're going, to know what that number is for you, because there's going to be a lot of competition coming up for everything that I just before mentioned, and it's an election year. Got to keep that, you got to understand that, right? You got to understand that because all those things matter. But these notes, these Fed notes, if you guys want me to start breaking those down, let me know. And I'll try to pull out what's pertinent and show it to you. But again, when we're reading what this Fed president is saying, it's all lining up with what I'm saying, right? So now going forward, the reports I think we really should look at, okay, as a result of these leading indicators, if they're really telling us what I think they're telling us, then the CPI report, right? The CPI report, when is it here? Next, right here, boom. Next Tuesday comes out at 8:30, right? And then we're going to go into the core CPI and things of that nature. That's going to let us know where we really are and let you know, right, what's really going on. And then, once you're qualified and ready to go, okay, you can then play the game of, where are we in the trend of rates? Because this is not like going to the grocery store, guys. You can't just say, okay, I'm going to buy today. Because you got to find a house. You got to contract on the house. You got to negotiate, make sure it gets accepted. Maybe you go through your option period and something blows the deal up. You have to be proactive. That's what I'm seeing a lot of folks are missing. And that proactivity starts with knowing that you can borrow the money. Now, if you got cash, I'm not talking to you. God bless, right? You could be a little more, I won't say lax, but you don't have to move with as much urgency because you don't have as many boxes to check, right? So I think I made my point there. I keep talking about this stuff, but I'm not showing you guys. This is the 10-year Treasury note, right? So again, it's up, okay? Rates are up. That's my point there. That's where you guys can kind of watch and track and gauge and validate what I'm telling you is true, okay? So now, let's do this, and then I'm going to let you go. U-Haul. This is another leading indication, a leading indicator of Texas as a micro thesis, right? And so long story short, this report comes out every year. This is January. When did this come out? January the 3rd, right? And this is their report of one-way DIYers, do-it-yourselfers, right? Folks looking to save money, makes sense with everything we're talking about. And they're saying, hey, we're going to move. We're not going to pay a big commercial company to move us, but we're going to move ourselves. So that's what this report is looking at. Long and short, it says Texas is the #1 growth state for the second consecutive year and the 5th time since 2016. It says Florida, which ranks second, has been a top 3 growth state 7 years in a row. So as you can see again, Texas, Florida, #1 and 2. I like this report better because, again, folks are looking to save money, right? If you got to move and you could do it yourself, that's a leading indicator. I tend to believe this data a little more. Moreover, the eyeball test, where I currently reside in the great state of Texas, a lot more people, a lot of construction, a lot of home building. You can't, you almost got to put your bows out now when you go around. Okay. So the information is accurate. Why is that important? In light of everything that we're talking about, more competition. In fact, this week, okay, how many applications we have? 8 applications this week thus far. And 6 of them are from people outside of the state of Texas coming here. So those of you that have been here in Texas, again, you get that complacency effect. It'll be there. Y'all better wake up. Reach out. Start the process. Find out what it is that you can do. Make sure your credit is sure and your income could get it. Because a lot of you guys, you wait till the last minute and then there's issues. Okay. That's the reason that's the case, to properly qualify. If not with me, whoever it is that you know, like, and trust. Make sure they know what they're doing though. It's important nowadays, right? So Texas, they're moving here. Okay. U-Haul's telling me that. Okay. Now I want to go a little deeper. Texas has a great resource in the Texas A&M Research Center. Now, what you're looking at here, let me scroll to the top, and hopefully I don't make anybody nauseous. But this is the Texas housing activity, okay? And looks at home sales 21, 22, 23. Want to make a couple of cases, okay? And let's start in 2019, right? 2019. And I'm going to start the last quarter. First case I want to make, generally, I guess I need to go back a little further. No, it's not going to work with me. But generally here, we'll start, that's 99, I'm tripping. 2009, no wonder the numbers look crazy. We'll start in 18. Generally, the last quarter of the year, okay, you have a tailing off of the number of sales. This row is the number of sales. So when you hear some of these folks online saying sales are in tanking and application demand is not here and things of that nature, that's the normal ebb and flow of the market, the housing market when you're selling homes. So typically October, November, you really don't have a lot of folks that are moving around. If you think about it, the majority of people are going to move around when the kiddos are out of school, right? That's most of the time when people are moving around, okay? The majority. So that's my point. You got a natural ebb and flow of a tailing off October, November, December of the prior year, and then going into the new year, 2019, right? It starts ramping up really the second week of January, okay, as far as homes being inventoried, okay? That's what we're looking for because there's been a lack of inventory. That's one of the causes of the higher home prices, right? So that's my point I want to make there. So we go into January, February, March 2019, and you can see the home sales are increasing naturally. More importantly, look at the number of months of inventory. If I got any realtors watching or anybody watching later, let me know here in Texas, whatever MSA, whatever market you're in, it's my opinion, a healthy inventory situation is anything between, I'd say 5.5 and say 4.5 to 6 months worth of inventory. But we can look back at this time, inventory still wasn't very heavy. And the reason being is, if you go back and look at this U-Haul article, Texas, I did a video a couple of weeks ago, but basically from 2000 to where we are now, I mean, it's almost been 10 million people. There's 30 million people in Texas. A lot of folks coming here. So inventory was already, on the lower end. That's my point, right? So let's fast forward. Nobody knows what's going on. Boom. We heard about the demic in other countries and stuff, but come December, it was notable to me, December 2019, that's when they start talking about it around in these United States, right? And again, 19, let's look at October, November, December. Low inventory, in my opinion, but starting to tail off for that year, okay, going into January 2020. So I remember it like it was yesterday because we were on vacation, spring break, March 2020, when they told us, like my daughter, hey, y'all going to be doing it from home. We locking it down. I don't know where you guys were at. But here's my point. Look at, right? Look at the volume, pardon me, because I might have got that wrong. Give me a second here. Let me go back to the top. There you go. That's the dollar volume. Sales is over here. I apologize. Same concept though. Let's go back because it's going to ring true. So the sales, look at the sales. They're lower, start picking up. But then, boom, it hits. Now, around this time, I got some folks with 2% interest rates because, I'm really your lender for life. So hopefully your lender was on it and reached out to you and said, hey man, it was an anomaly. So much so, and I won't go into that, but folks in the business know they stop things. But I got a couple of folks down in the 2% range, not 2%. Okay. But this is when it started hitting the fan, right? Now let's look at the number of sales. They're increasing, right? Increasing. You see the dollar volume, number of sales increasing, and look all the way here. Let me just highlight this range. Look at the number. I'll stop right here for right now because this is when we first hit. So from April 2020, number of sales increasing, 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 increasing. Look at the inventory. Inventory is already low. It's going down. Why am I doing this? Because you guys are listening to the wrong people, respectfully. Okay. You're listening to folks that are hitting you with your emotion in that you feel like, man, I don't want to pay that price for that house. Who does? I don't either. Right? Especially if you were around at this time, okay, and you could have got a home for a lot less and an interest rate for a lot less. I get it. But you can't stay in that mindset because 3/4 of Americans, their number one asset is going to be their home. I know you guys are investing. I know you watching the internet and the social medias, and you got all your favorite celebrities that you guys have created that you follow, and they all over the country. And they, if I see another video, you can tell when somebody buy a watch. They pull their hands up and they all up in here because they want you. See, all of those are diversionary tactics. You see, but nobody could get into the numbers. You're listening to the wrong people. You got to get in. It's past. It's gone. Right? What you have to do is get on the property ladder. And then if another opportunity comes to refinance and lower rates, if you have the right team in place and you're doing what you're supposed to do, you can capitalize. Okay. I digress. Let me quit being petty. Back to the numbers. So as you can see, inventory over here is getting less and less and less and less and less and less. Right? Now, to me, this marked a couple of things that we're realizing now. This was really a paradigm shift from the old way of work to the new way of work. You may have heard me say this before. I've coined this, that the home is the new corporate office. For some, it might be full-time, but for a lot, it's going to be hybrid. And all you got to do is go and look at commercial real estate and things of that nature. And if you're honest with yourself, you'll see what it is that I'm saying. It's been a shift. Okay. Just like I'm speaking with you today, I would admonish you guys, older folks as well as younger, you got to understand the internet. Okay. It's about efficiencies, and it's working out all the inefficiencies or disruptions. That's what they call it. It disrupts inefficiencies. And these folks that understand how to do that, they everywhere they can disrupt, they're going to disrupt. Okay. So it was a paradigm shift. That's why you start seeing these homes during a time where everybody's scared and you can't go anywhere. Why are all these homes selling? Got to think about it. So anyway, November 2020, let's keep going down so I can wrap this up. Got to get back to it. But look at the inventory. Inventory is going down, 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 down. 21 is going down. Let me see here. I need to find out when was the first. Let's see here. Let's see here. Maybe March. Okay, March of 2022. But look at these sales. Look at the volume. Okay, crazy volume. Even into the last part of the year where you normally start seeing a runoff, and inventory is down to a little over a month. Supply and demand. Okay. Now these new median and average prices that are being set, they're not going to go back to 2019, guys. They're not. You might see a decrease in the rate of inflation here recently, what I aforementioned. But if they go back to 2019 problems, we inflate, not inflation, but the unemployment rate is going to be back like in 2008. A lot of y'all, you're not going to be able to buy then, right? You're going to be losing stuff. Okay. Unemployment is going to be 12, 13, 14%. I understand you want a lesser price, but you got to understand how the system works. That's why I'm trying to explain it to you. They don't teach us this stuff in school, right? So anywho, as I round the corner, okay, It was about March of 2022. Okay, here in Texas, we got a little over a month worth of inventory. Everybody's, man, I'm putting 25 offers in on a home. These folks coming in with cash, woo, 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 yada, 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 right? And Texas was popping even then. That confirms what U-Haul is saying. Okay, you got competition. So now the Fed starts increasing the Fed funds rate and goes on a tear. And then you can see the result, right? Takes a little time because it's not an immediate, it's a lagging indicator to work through the system. Okay. But you start seeing the inventory starting to increase again, right? Starting to increase because we've been enduring all of these um, uh, rate hikes to try to quell inflation. Another key important thing is here. Let me start in November of 2022. Give me a second. I apologize. November of 2022. Okay. Going into January, we see the inventory starting to increase, but look at the sales volume. I mean, that's a precipitous drop. Okay. So everybody was looking for the 2008, and I'm gonna get in and buy all these houses. The crash happened in the number of sales. That's where the crash happened. And it happened in the number of sales because they increased the interest rate very, very high and put a lot of folks that want to buy on the sideline. And there was already a ton of folks built up demand even from 2012. Okay. But I'll keep going. So as you can see, the shortage, if you will, or the crash is going to happen in the sales volume. But Texas is still pretty resilient economy, and that's probably why a lot of people come here. A lot of good jobs and things of that nature. A lot of 21st century type jobs. You know, folks are making money. So I said this a couple of weeks ago. Don't be the person that you have perception and perspective. And see, you perceive that everybody's in your situation, but you got to get perspective, right? Because they got folks that can afford. Even at 8%, people were buying. And the numbers show you here, right? Okay. The numbers show you, okay? Even during 2023, the volume of sales have increased in Texas. So I said all that to say real estate is local, okay? Real estate is local, and you have to understand these numbers. So that's it. I appreciate those of you that stopped by. Again, guys, you know what? I'm running too quick. Let me do this real quick. Let me go back because I got the down payment assistance programs. If you're in the great state of Texas, right? Got T-Shack. Great program. They offer down payment assistance in a couple of different ways. Due to the number of folks that have been taking advantage of it, the mortgage credit certificate is not available at this time in any flavor. But still some other great programs to help you get over the hump and get on the ladder. We also have TDHCA here. Let's do this. Come on, computer. Come on, computer. This is T-Shack. Okay. Let's do TDHCA. This is the Texas Department of Housing. What is that? I get it wrong a lot of times, but long story short, this is another down payment assistance program. The mortgage credit certificate is not available here. Moreover, got some new guidelines this year with this program. And here's the deal. If you guys are renting, the number one thing is you have to be able to document your rent. Hopefully you're not paying in cash, but they're taking a page from FHA. And if the new mortgage payment exceeds your current rent by 1.5 times, then you have to have an amount in reserves. Not going to go over it here with you now, but if you want to know, reach out to us. That's the part of getting qualified. Okay. But when you wait, things change. That's my point. Okay. Then we also have for my veterans that qualify, you got your version of the bonds. These rates come out weekly, every Monday. If you really want to take advantage of this, you need to reach out so we can make sure that you qualify and secure your funds. I would say no later than Thursday of that week. This week, if you meet the requirements for the discount, interest rate is at 5.65%, which is below market. And these That's a rate, in my opinion. Once we get to 5.5% or lower, this thing is really gonna run. So you really got to be prepared. Point I want to make is, get yourself lockstep, lined up, ready to go. For my nationwide folks, as well as in Texas, this is on the conventional side. We got the One Plus, Purchase Plus. They both offer free money, grant money that has no conditions tied to it if you qualify for the program. One Plus, the caveats are purchase price can't exceed 350,000, which that's a lot of folks in Texas. Okay. And you have to be at or below 80% of the area median income. That's the two main things. Okay. Purchase Plus, there is no income requirement. You can do the conforming loan limit, the max, if you can qualify. But the key thing with this one is you have to be living in a certain census area at the time of application. And then if you qualify there, then you could buy anywhere in the country. Reach out, reach out so we can qualify you. That's the key. There's only so much you can do online. You feel me? You gotta make a move. Gotta make a move. So now I could get out of here. We covered it all. We covered the economic reports, gave you my theory or my methodology on how you should look at things going forward, leading indicators opposed to lagging indicators, and how to interpret that information. Get very comfortable with the 10-year Treasury note. We want it below 4% for, I'll just leave it there. And then, yeah. We talked about the mortgage rates, where they are as a result of how the 10 years yielding higher today. And then we talked about down payment assistance program. So that's it, man. Try to keep these things short and sweet because I don't want to, chew your ear too much. Again, guys, you have a great weekend. Be safe. Enjoy your family. And if we can be of assistance, reach out. Blessings.